Some assets appear valuable, others quietly control them. Why do two individuals invest similar capital, assume comparable risk, yet experience radically different outcomes over decades? The explanation is rarely effort, intelligence, or timing. It lies in hierarchy. Not all assets sit on the same structural level. Some generate income, others generate influence over income, and a rare few determine which income streams survive at all. If wealth feels unevenly distributed, could it be because most people accumulate the wrong layer without realizing it? Years ago, I focused obsessively on accumulating what seemed responsible: savings accounts, diversified funds, small income streams. On paper, everything looked stable, yet something felt constrained. My financial growth required constant input. When I stopped, growth slowed. I began noticing others whose assets expanded regardless of daily involvement. They weren't working harder. They owned something positioned differently. That observation unsettled me. Was I building income or was I building leverage? And if there is a difference, why is it rarely explained clearly? Most people evaluate assets based on return percentages. They ask, what yield does this produce? Rarely do they ask, what does this asset control? A rental property produces cash flow, but who determines zoning regulations, financing access, tenant demand, or development expansion? A stock produces dividends, but who shapes the capital structure, strategic direction, and pricing power of that corporation? The visible return distracts from structural positioning. If you measure assets only by income, are you ignoring their place in the broader architecture? Hierarchy is not about superiority, it is about structural placement. Think of assets as floors in a building. The ground floor houses labor. Above it sit income-producing assets. Higher still exist equity, brand authority, intellectual property, distribution systems, and infrastructure control. Those on upper floors influence conditions below. When interest rates shift, who benefits first? When policy changes, who absorbs the least damage? When demand spikes, who captures disproportionate upside? If you occupy the lower levels, you feel movement. If you occupy the upper levels, you create it. At the base of the hierarchy sits labor. Labor is necessary, respectable, and often well compensated, yet it remains structurally capped. It trades time for money, and time cannot compound. Promotions may increase income, but the ceiling always exists. Even highly skilled professionals remain dependent on demand for their effort. If their output stops, revenue stops. Labor produces value, but it does not control the system that assigns value. If you depend solely on labor, who ultimately determines your leverage? Da Vinci understood hierarchy intuitively, though he rarely spoke of it explicitly. He did not limit himself to painting. He designed systems, studied engineering, analyzed anatomy, and negotiated patronage. Why? Because influence over multiple domains compounds faster than excellence within one narrow function. Mastery at the surface creates admiration. Mastery of structure creates autonomy. He recognized that positioning determines opportunity long before effort enters the equation. If your assets confine you to execution alone, are you participating in hierarchy or reinforcing it? Above labor sit income-producing assets, rental properties, dividend-paying equities, bonds, digital products. These appear powerful because they generate cash flow without daily effort. Yet even here, hierarchy matters. Owning a single property differs from owning the financing institution behind properties. Holding shares differs from influencing corporate governance. Passive income reduces dependence on time, but it may still depend on external conditions you do not shape. Does your asset generate returns, or does it influence the rules under which returns are generated? Consider equity. Equity represents ownership within a structure rather than participation beneath it. When you own equity, you capture upside from collective output. Yet even equity varies in position. Minority shareholders absorb volatility without steering direction. Majority stakeholders influence capital allocation, strategic pivots, mergers, and pricing power. The difference between earning dividends and shaping corporate trajectory is profound. One reacts to decisions, the other defines them. When evaluating equity exposure, do you assess percentage returns alone or degree of control embedded within ownership? Above equity lies intellectual property. Intellectual property does not merely participate in markets, it shapes them. Patents restrict competition, proprietary technology alters cost structures, algorithms determine visibility in digital economies. A company may manufacture products, but the patent holder controls production rights. A media platform may host content, but the algorithm determines reach. Intellectual property functions like a gate. It does not chase income, it decides who may generate income. If you do not own intellectual property, whose gate are you standing behind? Higher still exists brand authority. Brand is stored trust. Trust translates into pricing power, loyalty, and margin expansion. Two products may be identical in function, yet one commands premium valuation because perception compounds. Brand shifts negotiation leverage. Investors pay more for predictable revenue streams associated with trusted identities. Consumers tolerate price increases when confidence remains intact. Brand is invisible on balance sheets, yet it influences market capitalization dramatically. When markets fluctuate, what protects valuation more reliably than accumulated credibility? Distribution control sits above brand. Distribution determines access. Without distribution, even superior products remain unseen. Platforms, media networks, retail channels, and digital ecosystems function as arteries of commerce. Whoever controls distribution influences visibility, pricing, and competitive dynamics. Manufacturers compete for shelf space. Content creators compete for algorithmic placement. Startups compete for user acquisition channels. Distribution is not glamorous, yet it dictates flow. If attention equals currency in modern economies, who benefits most, the creator or the gatekeeper? If this exploration of structure resonates, consider subscribing. This channel is built for those who value understanding beneath appearances, who prefer mechanism over noise, and who examine capital structure, leverage, and long-term wealth architecture carefully. Growth here is not about trends, it is about clarity sustained over time. If you seek deeper examinations of asset positioning, ownership dynamics, and structural advantage, remain aligned. Understanding hierarchy is not urgent, it is deliberate, and deliberate thinking compounds quietly across decades. At the top of the hierarchy sits infrastructure. Infrastructure is rarely discussed in personal finance conversations, yet it determines the conditions under which all other assets operate. Payment networks, energy grids, communication systems, logistics corridors, regulatory frameworks, these form the operating environment of markets. Those who influence infrastructure shape incentives across entire industries. When transaction costs fall, certain businesses flourish. When regulations shift, entire sectors reprice overnight. Infrastructure does not chase opportunity, it defines where opportunity can exist. If you cannot influence infrastructure, you adapt to it. Notice how each layer controls risk differently. Labor absorbs volatility directly. Income assets buffer some unpredictability but remain exposed to macro forces. Equity participates in strategic shifts yet may lack governance authority. Intellectual property restricts competition. Brand stabilizes demand. Distribution governs access. Infrastructure sets the boundaries of participation. As you ascend, uncertainty becomes something you manage rather than endure. Risk does not disappear, it transforms. Instead of reacting to conditions, higher layers design conditions. Which form of risk do your current assets carry? Many investors diversify horizontally, spreading capital across similar level assets. Multiple properties, several dividend stocks, various bonds. Yet, horizontal diversification within one layer does not change structural position. Owning 10 properties still differs fundamentally from controlling the financing terms affecting thousands. Diversification can reduce volatility, but it does not elevate hierarchy. The question is not only how many assets you hold, but where they sit. Are you multiplying exposure within a level or climbing into influence above it? Leverage operates differently across layers. Financial leverage amplifies returns, but also magnifies vulnerability. Operational leverage increases margins through scale. Intellectual leverage, through code, systems, or proprietary processes, extends output without proportional input. Reputational leverage accelerates trust. Structural leverage compounds quietly when positioning aligns with expanding systems. Not all leverage is equal. Some depend on debt, others depend on design. When analyzing opportunities, do you evaluate leverage type carefully, or are you drawn only to projected upside percentages? Consider a regional developer who began by purchasing small residential properties. For years, growth was steady but limited. Eventually, he shifted focus. Instead of acquiring more units, he partnered with lenders and secured equity stakes in development projects. Later, he negotiated influence over zoning discussions through advisory roles. Income no longer depended solely on rent, it depended on project approvals and financing terms. His net worth accelerated not because he worked longer hours, but because he repositioned upward. What changed, effort or hierarchy? Da Vinci moved similarly between layers. He did not confine himself to commissioned work. He cultivated patron relationships, influenced court environments, and positioned his expertise within systems of power. His creations generated admiration, but his access generated continuity. The distinction matters. Execution produces value within constraints. Positioning reshapes constraints themselves. When you evaluate your assets, do they anchor you to output, or do they grant access to structural influence? Influence often compounds more quietly than income, yet its effects travel further. If this hierarchy framework aligns with your experience, reflect in the comments. Does your current asset allocation place you primarily in reactive layers, or have you begun positioning upward? Clarity often begins with recognition. Many individuals accumulate diligently without questioning structural placement. The intention here is not criticism, but awareness. When you examine your portfolio, whether equities, real estate, intellectual property, or digital ventures, does the distribution reveal strategic elevation or concentration within familiar levels? Share a single word that captures your realization. Hierarchy also explains valuation disparities. Companies controlling platforms command higher multiples than those supplying products beneath them. Infrastructure firms attract long-term capital because revenue streams depend on regulated necessity. Brands with pricing power maintain margins during inflationary cycles. Meanwhile, commodity producers face volatile swings determined by external forces. Markets price control differently from participation. If valuation reflects perceived durability and influence, why would identical earnings receive identical multiples? The answer rarely lies in effort. It lies in structural authority embedded within assets. Technology has intensified hierarchy visibility. Software platforms scale globally with marginal cost near zero. Data ownership enhances predictive power. Network effects entrench dominance. Those who build systems capturing recurring transactions accumulate structural advantage rapidly. Meanwhile, participants operating within those systems compete for visibility governed by algorithms they do not control. Digital economies reward architecture more than activity. When evaluating modern opportunities, artificial intelligence, fintech, media platforms, are you entering as contributor or as partial architect of the framework? Capital structure further reveals hierarchy. Debt holders receive fixed returns and contractual protection. Equity holders capture upside but absorb volatility. Preferred shares negotiate hybrid positioning. Venture capital firms influence governance beyond simple ownership percentages. Private equity restructures incentives entirely. Financial engineering is not abstract. It determines priority during stress. In downturns, whose claims are honored first? During expansion, whose participation multiplies disproportionately? Understanding capital stack positioning often explains wealth outcomes more accurately than revenue projections alone. Time interacts with hierarchy asymmetrically. Labor compounds only while applied. Income assets compound when reinvested. Equity compounds when retained earnings expand intrinsic value. Intellectual property compounds as distribution widens. Brand compounds as trust deepens. Infrastructure compounds as usage becomes indispensable. Time is not neutral. It favors higher layers. When cycles fluctuate, lower layers feel contraction immediately. Upper layers adjust terms and preserve momentum. If time amplifies structure, what exactly is your structure amplifying? Scarcity operates differently across layers as well. Labor supply fluctuates with education and demographics. Rental units expand with development capital. Public equities adjust through issuance and buybacks. But true intellectual property remains scarce by definition. Trusted brands cannot be replicated instantly. Established distribution channels resist displacement. Infrastructure monopolies often operate under regulatory protection. Scarcity increases pricing power and valuation stability. When markets saturate, which assets remain defensible and which become interchangeable, pressured by competition? Pause again and consider your position. Does this hierarchy clarify why certain individuals appear insulated during volatility while others scramble to adjust? If the framework resonates, leave a brief reflection below. Awareness often begins quietly. No dramatic shift is required, only recognition. When you categorize your current assets by level, labor, income, equity, intellectual property, brand, distribution, infrastructure, where is concentration highest? Identifying placement is not judgment, it is diagnosis. Diagnosis precedes strategic elevation. Elevation does not require abandoning lower layers. Labor can fund equity. Income assets can finance intellectual property. Equity can acquire distribution channels. The hierarchy is dynamic, not rigid. The key lies in intentional transition. Many remain confined because reinvestment reinforces the same level repeatedly. If surplus cash always returns to similar assets, structural movement stalls. What if instead each layer became a stepping stone toward influence above? Compounding accelerates when reinvestment alters positioning, not merely quantity. Consider negotiation leverage. A skilled employee negotiates salary. A shareholder negotiates governance terms. A patent holder negotiates licensing fees. A brand owner negotiates pricing power. A platform negotiates visibility rules. An infrastructure controller negotiates access itself. Each layer negotiates from a different vantage point. The higher the vantage point, the fewer counterparts dictate conditions. If negotiation outcomes shape financial trajectories, which vantage point offers greater resilience over decades? Many mistake visibility for hierarchy. Influencers appear powerful, yet often rely on platforms owned by others. High-income professionals appear secure, yet depend on institutional structures. Surface metrics, followers, salary, revenue, can obscure structural dependence. True hierarchy reveals itself when conditions shift. Who adapts terms effortlessly? Who absorbs shock? Who retains optionality? Optionality, the freedom to choose direction without coercion, signals elevation. If external decisions can abruptly alter your trajectory, how high is your position truly? Optionality increases as hierarchy ascends. At lower levels, choices narrow under pressure. Missed income affects immediate stability. At higher levels, diversified control over assets, distribution, or infrastructure creates flexibility. Capital can shift sectors. Intellectual property can license across industries. Platforms can adjust algorithms. Optionality is not luxury. It is strategic insulation. When uncertainty rises, who retains the ability to pivot without distress? Optionality reflects structural altitude more accurately than reported net worth. Da Vinci's enduring legacy was not confined to masterpieces, it was rooted in structural positioning. He navigated courts, secured patronage, and integrated knowledge across disciplines, ensuring continuity beyond singular commissions. His work traveled because his positioning allowed it. The lesson is not imitation, but awareness. Craft matters, execution matters. Yet without structural elevation, output remains bounded by circumstance. When evaluating your trajectory, are you refining craft alone, or also refining placement within the hierarchy? This channel is not built on hype or shortcuts. It exists to study principles, decisions, and clarity. Understanding always comes first. But when insight moves from theory into real life, structure becomes necessary. Without it, even sound decisions erode over time. I use a simple system personally to keep finances deliberate, clear, and under control. No subscriptions, no noise, no dependence. A single, intentional setup designed for ownership, not convenience. It's available for those who value clarity and autonomy. The link is below. Clarity always comes first. Understanding hierarchy is intellectually simple. Acting on it is psychologically difficult. Why? Because elevation requires temporary discomfort. Moving upward often means abandoning familiar metrics of success. Salary titles, visible income, predictable routines, these feel secure. Structural repositioning feels uncertain. Many prefer stable visibility over uncertain influence, yet comfort reinforces horizontal repetition. If the current layer feels safe, what incentive exists to question it? And if safety anchors you in place, how often does opportunity pass unnoticed above? History reveals consistent capital migration toward higher layers. During industrial expansion, infrastructure magnates accumulated disproportionate control. During technological revolutions, platform architects captured outsized valuation premiums. During financial deregulation, institutions influencing capital flow multiplied scale. Meanwhile, participants within systems experienced volatility cycles. This pattern repeats. Capital gravitates toward control nodes, not because of morality or fairness, but because control stabilizes cash flow and expands optionality. When observing modern markets, are you tracking trends or identifying where control is consolidating? Institutional investors rarely chase isolated assets blindly. Pension funds, sovereign wealth funds, and private equity firms analyze positioning within capital stacks and infrastructure frameworks. They evaluate regulatory insulation, network effects, and pricing durability. Their mandate is longevity, not excitement. That preference alone reveals hierarchy awareness. If long-horizon capital consistently favors structural control over speculative yield, what does that imply about long-term wealth resilience? Retail participants often focus on returns. Institutions focus on leverage over systems. Psychologically, upward movement requires identity adjustment. It demands seeing oneself not merely as earner, but allocator. Not merely as participant, but partial architect. That transition feels abstract at first. Yet every allocation decision either reinforces current positioning or nudges elevation. Over decades, small directional adjustments compound. If hierarchy compounds asymmetrically, then even modest structural shifts can reshape long-term outcomes. The challenge is not access alone, it is perception. Do you recognize elevation opportunities when they appear? There is also a cost to remaining stationary. When lower layers experience compression, automation reducing labor demand, competition narrowing margins, regulatory shifts altering economics, those positioned above absorb change more fluidly. They reprice, restructure, or redirect capital. Those below adjust to decisions made elsewhere. Inaction is not neutral, it preserves exposure. If structural compression accelerates in modern economies, does maintaining the same layer truly represent stability? Hierarchy does not guarantee dominance, nor does it eliminate responsibility. It clarifies terrain. When you understand terrain, movement becomes intentional. You recognize why certain valuations command premiums, why capital concentrates around platforms, why intellectual property multiplies margins, why infrastructure attracts institutional investors. The objective is not envy, but literacy. Structural literacy transforms how you evaluate opportunities, negotiate contracts, and allocate capital. If wealth outcomes appear uneven, perhaps hierarchy explains more than effort ever could. And there you have it, Da Vinci and the asset hierarchy that controls everything. We explored why effort alone remains capped, how structure reshapes outcomes, and why leverage has always been the silent driver behind accelerated results. If this video sharpened your thinking, continue with the next video. It will take you further. Support the channel by liking, sharing, and subscribing, and leave your thoughts in the comments. Stay sharp, stay intentional the way Da Vinci crafted his work, through proportion, not noise. Keep crafting your wealth deliberately, one structured decision at a time. Thank you for being here. I'll see you in the next video.